If you trade stocks, you might have the impression that options are just too risky or maybe too complicated. But what if I told you that's not the full story? In fact, learning to sell options could make your stock trading not only safer, but potentially more profitable. When I first learned how to sell options, my first reaction was, wow, this is awesome. It really solved so many of my problems. Today, let's first talk about these two topics. Myth 1. Are options extremely risky? This statement is not wrong, but it's only half true, because options always involve a buyer and a seller. Buying options is very risky. In the last video, I explained that buying options is like being a gambler, while selling options is like running the casino. When it comes to selling options, there are two main types: selling puts and selling calls. Selling puts is generally less risky than simply buying stocks. Selling calls can be divided into covered calls and naked calls. I'll explain the details in future lessons. Naked selling is something I strongly discourage. With covered calls, the risk is merely that you might end up selling your stocks too early. In my course, I will not teach or encourage buying options. I focus entirely on selling options. You could say that, within my framework, selling options is actually less risky than trading stocks. So, let's summarize why many people say options are very risky. First, buying options. Buying options is like gambling and indeed very risky, but here we are talking about selling options. Second, naked calls. The key problem is naked selling, which is very risky, not the call option itself. In fact, naked call selling is slightly less risky than naked stock selling. Naked selling is inherently leveraged and losses are unlimited. Third, oversized put selling. Since selling puts can involve leverage, some people sell too many contracts. Again, the problem is leverage, which is always risky, not the selling of puts itself. In fact, leveraged put selling is still slightly less risky than leveraged stock buying. As long as you avoid these three problems, selling puts and covered calls are not that risky. Myth 2. Are options extremely complicated? Many people, when they start learning about options, get overwhelmed by all the terms: put, call, strike, premium, expiration date, even things like delta and gamma. What the hell? But actually, the basic logic of selling options is very simple. I will skip the definitions and explain selling options in a simple way. First, the name is option contract. Maybe it was called option to make it easier to understand. But in fact, the option contract is not the same as the daily meaning of option. This is essentially a contract between a buyer and a seller, and at its core, it's just a settlement rule under two possible conditions. What are those two conditions? Whether the future price of the stock is greater or less than an agreed-upon specific price, called the strike price. So you can see, this has nothing to do with the way we use option in daily life, right? Second, options have many elements, but what is the core? When we buy stocks, the most important thing is price. For selling options, the most important thing is also price, just slightly more complex. Stocks involve one price, options involve three: the stock price, just for reference, the strike price, the premium. Let's start with selling puts. If the price is above the strike, you simply keep the premium. If the price is below the strike, you must buy the stock at an effective cost of strike minus premium. That's the core of selling puts. The opposite side is the put buyer who takes on the opposite position. You can work out what he has to take on your own, or look it up. But honestly, it doesn't matter if you don't fully know. If you're just selling puts, all you need to care about is the part I just explained. Like any contract, what matters most is what you get out of it. Yes, there are other elements, like the expiration date, which simply means when the two scenarios are judged. That's it. It doesn't really add complexity. Another factor is contract size, which tells you how many shares are covered. We'll go into that during practice, but it doesn't change the essence of options. Of course, some people who know options will jump in and say, but what you just explained is the exercise settlement, and option buyers don't have to exercise. True in theory, but in practice, have you ever seen someone not exercise? The only reason this concept exists is that the contract is called an option, and people try to connect it to the everyday meaning of option. That just makes a simple thing way too complicated. we can safely ignore it. So, if we focus on selling puts and grab the core logic, it's not so difficult. Now here comes the key part. Pay close attention to these two scenarios. Which one would you prefer? This is actually very important because whether you prefer to collect the cash or to end up buying the stock reflects two different motivations and strategies. First, let's talk about the case where you prefer to actually buy the stock. In this situation, your motivation is, you actually want to buy the stock, but you hesitate at the current price. If you could get it a bit cheaper, you'd be happier. And if the stock suddenly rallies and you don't get it, that's fine too. You still pocketed some income. This may sound a bit abstract, but think about it. Have you ever been stuck in this dilemma? If a stock is truly bad, you wouldn't hesitate. If it's truly amazing, you wouldn't hesitate either. But often you find yourself thinking it's not bad but not perfect. I think many of you have experienced this, and any seasoned investor will face this situation often. In fact, I've run into it plenty of times myself. I didn't buy a stock, and then it skyrocketed. I felt like kicking myself. Or I bought it, and boom, it dropped 20% overnight, and I just wanted to shut down my account and pretend I hadn't seen it. That's when selling puts is a fantastic tool. If the stock rallies, you didn't buy it, but you made some premium. If the stock drops, you did buy it, but at a cheaper, effective price. If I had known about this tool earlier, I would have made a lot more money in the past. Some people say, but you only make the premium, and that's not much. Well, let me share a piece of common sense. Long-term, steady returns do not come from chasing huge spikes. They come from stacking up small edges which compound over time. Selling puts gives you a consistent, repeatable way to either buy stocks cheaper or collect premium. Small wins add up, and over time they compound like a beautiful snowball. By the way, selling covered calls is similar. Selling puts helps you buy stocks cheaper, while selling calls helps you sell stocks high. Now let's talk about the case where you prefer to collect the cash. Here, your motivation is different. You really just want to earn the cash income, like collecting interest. But if you end up owning the stock, you're fine with that too. Sounds attractive, right? Congratulations, you've discovered a hidden gem. This is the legal small casino business I mentioned in the last lesson. So, how high can the returns be? I saw another YouTuber who makes a living from this. He reported about 2% per month. 3 points here. First, he was mostly selling puts on big companies like Microsoft. If you choose smaller companies, the yield is higher. Second, the number he mentioned didn't include leverage. Some people use heavy leverage. Personally, I stay within 2 times leverage. That's conservative compared to many put sellers. But to be clear, leverage amplifies risk significantly. Beginners should start with 0 leverage. Third, he was talking about normal market conditions. In volatile markets, option premiums are higher, so put selling is even more profitable. So, how much money can this business make? I'll let you imagine it yourself. Besides the steady returns, I also find it simpler than investing in stocks. Why? When we say selling puts is like running a casino, the essence is that when we sell puts, the odds are more in our favour. With stocks, maybe out of 1,000 companies, only 10 pass my risk-reward filter, but with puts, maybe 100 are acceptable. That means many more opportunities, and I can trade with a lot more ease. Of course, if there's a stock you really want, then selling puts isn't the right choice. You should just buy it, or buy some shares and sell some puts alongside. Because with puts, if the stock really skyrockets, you won't own it. Selling puts is only better when you're hesitant about buying the stock. Think of it as a spectrum. If you're very bullish, just buy the stock. If you're somewhat bullish and want to buy, sell a put as a tool to assist. If you just think the stock is okay, sell a put mainly to earn premium. So, how does selling puts sound now? Tempting, right? That's it for today's lesson. A quick update. My account starting from $500,000 has now grown to $530,000. My recent trades were selling puts on Google, Tiger, and Nvidia. By the way, before you jump in, I recommend you don't start selling options right away. Watch a few more lessons first. I'll cover specific trading techniques and risk management strategies that are essential before you take action. If you found this video useful, please subscribe and like. See you next time.